If an IUL policy is structured correctly, you'll likely get an average annual return of 6 to 10% tax-free. In this episode, I'm going to address the question, why does my insurance policy only get 2 to 4% return? Watch, I'm going to show you it's probably not structured correctly. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist for more than 46 years. And way back in 1980, when E.F. Hutton, who is credited with being the brainchild behind the emergence of universal life, introduced that concept, I thought, oh, wow, this is the answer, because I was a big buy term invest the difference proponent. But this was like buy term invest the difference on steroids, tax-free. And I could see that, where E.F. Hutton said, why don't we use a life insurance for living benefits primarily by taking the least amount of insurance the IRS will let you get away with and put in the most money that the IRS allows as fast as they allow. And this can turn into a tax-free cash cow. Way back from 1980 to 1990, I never earned less than 11.75%, as high as 15.5%, in fact, for the first decade. Then interest rates started coming down because interest rates are relative. See, when interest rates are high for earning, they're high for borrowing. Back then, mortgages on houses were at 12%, even 18 and 21%. So interest rates are relative. Now, the last couple of decades, we've been in a low interest environment, banks only paying 1% or less. And so most insurance companies have been paying on their general account portfolios between 4 to 5 to 6%, because that's all they're earning on mortgages or on bonds and so forth. And if you've watched other educational videos on IUL, you know that you can opt anytime you want just to settle for the general account portfolio rate of 4 or 5 or 6%. But you can link your returns to an index of your choice. Indexing came out in 1997, and that's where I tweaked my rates of return on my universal life policies from an average of about 8.2% up until that point to about 10.07% thereafter. So I increased my rate of return by about 2 percentage points using indexing. Now, some years with indexing, I may not earn anything, like 2008, but other years like 2009, I locked in gains of 16% after not losing any money due to market volatility in 2008. And so this is where indexing allowed me to be able to participate in the market, but not lose when the market goes down. Now, your policy has to be structured correctly. You have to take the least amount of insurance under the TIFRA and DIFRA tax citations and put in the most money as fast as they allow. And when you do that, you can maximum fund your policy in as little as 5 years to grandfather yourself to have tax-free income the rest of your life. So you may not get a great internal rate of return during the first 5 years, but the long-term goal is that the average over, let's say, 30 years, if you earned 9, you're netting 8. If you're earning 11, you're netting 10. Some years I've earned 25 and netted 24. But on the average, you want the cost of the insurance to only drain out about 1 of the percentage points so that you can be earning, let's say, 11 and net 10. And if you have $1 million of cash value when you retire, then you can theoretically pull out $100,000 a year, that's 10%, and never deplete principal, which many, thousands of our clients have actually experienced 10% payouts with their indexed universal life policies. But the saddest thing that happens is when people come, they say, hey, Mr. Andrew, I've been listening to you on the radio. I've read your books. I started my universal life policy 7.5 years ago. And I heard you on the radio say, well, another 7.5 years. And if you've averaged 10% like I have, your money should have doubled. So if you put in $500,000, you should have $1 million now into your index universal life policy. It should have doubled. That's without adding any money. That's just the money you had in there 7.5 years earlier. People would come and say, well, I put in $500,000 into my policy. It's only worth $250,000. Why? Where's the other $750,000? And I said, well, who set this up for you? Well, our nephew said he could do it. He had an insurance license. And I went, oh dear. Or my brother-in-law did. I said, that was an expensive relationship. Yeah, they had a license. They maybe even used the same company, one of the companies I use about 6, maybe even the same product. But it only took me like 30 seconds and I went, who designed this? You've actually been losing because they didn't design it correctly with the least amount of insurance under the TEFRA and DEFRA tax citations. Or if they put too much insurance in there, they could have been earning 11 and netting 10, but they were only earning 2 or 3 or 4%. Sometimes people say, how come my insurance policy only has been earning 2 or 3, 4% interest? And I look and I go, it's whole life. Whole life, they may tout that it's better because it has guarantees and everything, but whole life insurance typically may only credit you maybe 5 or 6%, but after the cost of insurance, the way they designed them, you might only net 2 or 3%. And so a lot of times whole life agents don't even know how to calculate internal rate of return. That's cash on cash. I had to teach them that. So if it's whole life insurance, maybe you're only really earning 2 or 3 or 4%. If it's universal life or index universal life, I can tell you right off the bat, whoever structured that did not know what they were doing, because generally speaking, you should be averaging more like 6 to 10%. So let me show you an actual example of this. So I'm going to use the lost decade. This was the worst decade since the Great Depression in the market. And we call it the lost decade because people went for 10 years, actually 12 years, and never came out really ahead at the end of the day. I often compare the stock market to a person with a yo-yo, hopefully walking up some stairs. During the decade from 2000 to 2010, that person with a yo-yo was walking across a flat surface, meaning the market went up and down and up and down. But at the end of 10 years, the S&P 500, the Dow Jones, the Russell 2000, all of these market indicators were basically where they were 10 years earlier. And so if you started out with $1 million in the year 2000, people still only had about $1 million at the end of 2010. It actually was usually 2012 for most Americans before they came back to break even. So let me show you this. The decade, we're going to start here in 1999 and see the market did go up. I wanted to give credit. Let's have it go up here. This is the S&P 500, by the way, one of the common indices that I use with my index universal life. So the market goes up, and then what happened in 2001, 9/11, the terrorist attacks, all of a sudden, bam, 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 3 years, and the market drops. For most people, they lost 40%. Some lost 50%. When you lose 40%, let's say you had $1 million at the peak. $1 million 3 years later was only worth $600,000 if your money was in the market, like most Americans who had IRAs and 401ks. Well, a 40% loss has to be followed by a 67% gain to get back to break even. See, a lot of people go, what? If you lose 40%, you need a 40% gain to get back to break even. No, you don't. $1 million going down to 600,000. 600,000 has to grow by 400,000, the amount you lost, to get back up to break even. 400,000 is a 67% gain on 600,000. So when you lose 40%, you must earn 67% increase to come back to break even. If you lose 50%, $1 million goes down to 500. 500 has to double. You have to have a 100% gain to make up for a 50% loss. So that happened from 2003 to 2007, and people, they were frustrated. They felt like they had lost their future. They had to put off retirement 7 years, and they thought, oh, now finally I have $1 million. It wasn't worth quite as much because of inflation. But then what happened in 2008? The mortgage meltdown. We came so close in this country to a total financial collapse. As Warren Buffett put it, he said, when the tide went out in 2008, it revealed who was swimming naked. These people were still naked in the market, unprotected, and they saw a 40% drop in one single year. It took 4 years until 2012 to come back up here. At the end of that decade, a lot of people still only had 630,000 to show for their million. It took until 2012 to come back up here to break even. So with indexing, if you simply put your head in the sand and fell asleep or whatever for that 10-year period, and during that time period, there were many of my universal life policies that capped out at 16 or 17%. Let's just say 15%. During these years, I earned 10, and then after 2001, 0, 0, 0. I didn't lose, but I didn't make anything. See, I didn't experience this loss. And then I made 15, and then 5, and then 6, and then 8. And then what happened in 2008 when it nosedived again? I didn't make anything, but I didn't lose, 0, 0. And then this year, 2009, 15%. I had 178,000 for the 100,000. Most people in America still only had $68,000 at the end of that time period. Now, if you go out here to 2012, most Americans had triple their money who used indexing and rebalancing, the strategies I teach. But if you actually go to 2012, most Americans who had their money in the market in IRAs and 401ks, they were barely back to break even. If they started out with $1 million here, they barely had $1 million at the end of 12 years, 0, okay? Most of our clients using indexing, they had $3 million because they used rebalancing and indexing, which I teach in other educational videos. So the point is this: if all you did was sit there and earn 0, 0, 0, 0, 0, 5 years, 0 was my hero. I didn't make anything, but I didn't lose. The other 5 years, I only capped out twice, but I ended up with doubling my money. 100,000 was worth 178,000. Just a few months later, it was worth 200,000. $1 million would have doubled to 2 million. That's just using indexing. That's not what I did. I only earned 0 this year and this year. The other 3 years, I moved my money back over and just earned the general account portfolio rate of 5% or whatever it was. It was actually more than 5 at the time. And I ended up with a far greater return, 9.6%, which doubles your money every 7.5 years. So folks, that's the power behind using indexing, but it's all contingent on the policy being structured correctly. If you take the least amount of insurance that the IRS will let you get away with under those tax citations, put in the most money, and you do it correctly, you should average 6 to 10%. There will be years maybe you only earn 0 and that's your hero when everybody else in America is running around going crazy because they're losing so much. I don't lose, but I make money. So if you're extremely conservative, you should earn more like 5 or 6%, but if you use rebalancing, and be sure and search for videos explaining that, you should earn returns more like 9.6%, which will double your money about every 7.5 years. So what's the point behind a properly structured maximum funded IUL policy? Is to take the least amount of insurance, put in the most money as they allow, as fast as they allow under TEFRA, DEFRA, and TAMRA. And if it's structured correctly, then your policy over the long haul should average between 6 to 10% rates of return based on actual historical history. I can't guarantee or predict the future, but that's why I use the worst decade to show you the example of how much better you could be doing than having your money in the market or sitting in a policy that's not structured correctly. And you're wondering, how come I'm only getting 2 or 3 or 4%? It's not structured the way that it can optimize your rate of return for living benefits. And that's unfortunately how many whole life policies are structured, more for the death benefit than the living benefit. And that's why the rate of return is so pathetic. So if you want to learn more about this, I would love to have you study this book, The Laser Fund. It's my 11th book. It's actually 2 books in one. This side is for you left brain thinkers. You want to get the charts and the graphs and the numbers. This has 14 chapters, but if you learn more by stories, you flip the book over. This has 12 chapters with 62 actual client stories. If you want to use both the right brain and the left brain, read both sides. This is how you can get your free copy. The book retails for $20. I'll tell you what, I'll pay for the book. You simply go to laserfund.com. You contribute $5.95 toward the shipping and handling, and I'll fire out a copy to you absolutely free. There's also options in there for the audio if you like to listen and learn, or the video if you like to watch and learn. Take advantage of that and learn how you can get your policy structured correctly so your rates of return are more in the 6 to 10% range.